David, we're the wrap-up act here. So, started with a conversation at breakfast this morning with Andy Whitehouse and a team from Penta, talking about all the things that would be on the agenda for yesterday, throughout the program today, was how do we make the good things happen that we all know should happen? And it all comes down to capital. And capital allocation, capital raising, capital investing has been your life. You're a New Yorker, you went to a little place for school up in Cambridge, I think they call it the Harvard Business School. And then you went and you became an entrepreneur in Israel, which is an interesting thing to do right out of business school. And then you came back, you were in banking, you were investing, and you've been all around the idea of venture capital for your whole professional career here. And venture capital, as we've heard during this program in other venues, a couple of people, and I mentioned this to you when we chatted last week, a couple of people who I have a world of respect for have made their decision that they're pure investors. So one is Bill Gross, who spoke to us here last year. The other one is John Doerr, one of the longtime leader of Kleiner Perkins. And both of them, extremely successful, very smart, have said that this is the best investment opportunity that they've ever seen, and they're committing all their resources to it. Tell us, what role does venture capital play in your world and potentially in this world, and what your role is in and around venture capital today?
So what's venture capital, right? Our job as an industry is to finance innovation, unprofitable companies that are typically high risk, right? We're the most expensive form of capital, right? I definitely recommend if you can get bank financing or something like that, or grants, do that. Don't go to guys like me. But a lot of people go to guys like me and gals like me because we're the only folks who will give capital to the raw, high-risk, unprofitable startup. From a climate point of view, one of the most challenging things about addressing the climate crisis is it is such a complex and pervasive problem. It is definitionally the environment we're all in, right? So it's not just a software problem or hardware problem, right? You have to rethink many, many different aspects of the society, of the economy to really mitigate it. And that goes to where Coolwater Capital plays. So Coolwater Capital, our firm, is a GP seeder. That means that we are in the business of training and financing the next generation of top decile VCs. For example, Planetary Capital, Sophie, who spoke earlier today.
Sophie was on the stage earlier today.
Right. So we have backed 256 VC funds, collectively raised $3 billion, and they're in all areas of innovation. Funds like Planeteer that are focused squarely on climate, other funds that focus on software or on hardware, but certainly are looking at climate solutions as part of it. And these fund managers need help learning how to build an asset management business and raising capital. And we help them do that. And so we're taking a broader approach about how do we put capital to work to help address this systemic problem.
Mm-hmm. And it's an unusual business to be a seeder of venture capital firms. And that's an enormous number. But you're not just seeding in that case. You're using your talents to find attractive ideas in areas, to find the people, to train the people. And at the same time, you're keeping in your field of vision the boxes you want to check around how is this business, whether it's devoted to climate or the environment in any way, how is it doing things that are good for the climate and the environment? And you've long been an advocate of finding all different kinds of diversity, yet I would suspect yours is an industry that's not terribly diverse.
That is certainly true. So let's talk about different types of diversity. So from the point of view of industry diversity, by the nature of our business model, we back all types of VCs, right? Fintech, software, hardware, climate, life sciences, femtech, you name it. Then second is on other types of diversity, right? So gender and racial. Our industry certainly is very, very weighted towards a bunch of white guys like me. At our firm, if you look at the fund managers that we have backed, 25% of all the fund managers we backed are female-led and or co-founded. The total industry is about 5% women-led, co-founded. And 42% of the fund managers we back self-identify as underrepresented minorities or people of color. That is not because we're an impact investor. We don't define ourselves that way. None of our LPs ask us, pay us to limited partners, meaning the people who give us money to manage. None of them are giving us a mandate to invest in impact. In fact, most of them, I would say that it's not really what they care about. They're looking for returns. But
These are like financial animals. They just want returns.
exactly, like show me the dollars. But we think, as like I'm doing my job, right? My clients are paying us to do this. I think that part of my doing my job of investing in high potential opportunities is being open to people and industries that other people may not pay attention to, right?
So it sounds like it's because it makes good business sense.
Exactly. So that was a general your, not you personally. So your discrimination, that was a theoretical person in the balcony. Your discrimination
Watch where you
is
talk.
my opportunity. Exactly. And so we make a point of opening the aperture wide to people from many different backgrounds and helping put them in business. And that accomplishes the goal of racial, gender, religious diversity, and also accomplishes our goal of industry
Give us
diversity.
some insights into, you say you open the aperture. It's nice to say, but what is it specifically you're doing to attract people to feel comfortable, A, that they could do this, B, that you're going to give them not only money but help, and how do they find your door?
Yeah, so one thing we very systematically have tried to do is go into rooms where we're the minority. So I'm on the advisory board of Culture Shifting Weekend. That's one of the largest conferences for black and brown VCs. I'm very friendly with Women's Sphere, which is an organization for women leaders. And I've been a speaker at these events, and as you can imagine, I'm very, very much the minority at these events. And I welcome that because I am meeting people who will bring a different perspective than I do, and that's a stretch, and I think healthy for me.
So tell me about Coolwater. How successful a firm is it? What kind of capital have you been deploying? What kind of capital do you have? Assets under management? I mean, that's a lot of conversations to get to that many investments.
Yes.
And I've never heard of another firm that does that.
So we're 5 years old, and we, as I said, have graduated 256 VC funds, and they collectively have invested in over 6,000 companies. So we are indirectly bigger than Y Combinator in the number of companies that we have helped to get into business. So we're a small organization by headcount. We're single-digit number of full-time staff, but we are growing rapidly. And the math of our organization is our funds are investing in north of 1,000 companies per year. So it's just ramping up every year as they continue to raise capital and deploy more of it.
What areas are you finding most exciting right now as potential investment areas?
So I'm particularly excited about investment tech, which I define as technology that helps investors generate alpha. For example, I'm an investor.
What is generate alpha?
Okay, sorry for the jargon. So money, generate returns.
So money over and above the asset class in general.
Yeah, so investment
So
tech.
alpha, if you're in the stock market and the stock market does 120 point improvement, you want something north of 120, and that difference is alpha.
Yes, thank you for calling me on my jargon. So for example, I'm an investor in Adipar, which is a company that helps family offices and RIAs, registered investment advisors, track their assets, figure out what they hold. I'm an investor in Stratify, which helps retail investors you do risk management in a more sophisticated way, the way institutions think about risk management. So this plays into climate because climate risk is a real issue, right? It's no longer theoretical. We're seeing real dollar costs. And so the smart fund manager, the smart investor, should be thinking about what risk do I have? Can I quantify it? How do I mitigate it? Just like you think about interest rate risk and other sorts of risk.
As long as we're getting to definitions, what size deals are generally considered venture, and when does private equity kick in above that? I assume that's where it's differentiated, the size of deals, maturity of the companies?
Well, OpenAI is raising the $150 billion valuation, which is way higher than most of the private equity industry.
You're not
plays.
writing that check?
I am not writing that check. I don't. But if someone wants to give me the capital, then I will deploy a check in that deal. Although I have my own separate conversation.
Would you?
Valuation is awfully rich, I would say. There are a lot of people in our industry who put money into companies for what we call logo reasons. They want the logo.
Yeah.
And so I get the idea of a Gucci logo that's a little more affordable, but putting in $150 billion might be a more expensive way to get a logo. So I would say the real difference is VC, as I said, the most expensive form of capital. The real line is the companies can't raise capital through some other means, usually because they're unprofitable and or unproven, and you're early in their development, right? If you think about the typical commercial bank, their requirements are normally 2 years of history and profitability, and usually at least, let's say $1 million of EBITDA, like sort of ballpark.
Proven management team.
Right, and a whole chunk of the economy doesn't qualify, and so they go to us.
Yeah. And what kind of returns do you target as a venture capitalist?
So VC, according to Cambridge Associates data, outperforms private equity in the public markets over the past 40 years. Of course, we have the highest...
Past 4 years?
40.
40.
But we have the highest dispersion of returns, which is a fancy way, trying not to use too much.
It's all over the place.
Yes. So the top quartile VCs are generating north of 20% IRR, and the bottom quartile VCs, you can lose your money. Not all your money, but lose a significant amount of money. As opposed to if you're investing, say, credit funds, the spread is much, much smaller between the top quartile and bottom quartile funds. And so that's a risk, and that goes
So in your
why,
portfolio, if you're a direct VC and you put money in something that becomes a billion-dollar company, that's going to wildly distort your returns for a couple of few years.
Yes, so it's a power law business, and that goes into why Coolwater exists, right? So there are a lot of people launching VC funds, not all of whom are qualified or going to do a good job. And so we're experts in assessing VC firms and figuring out who should get capital. And that's part of why folks want to work with us, is because we're a helpful filter in weeding out the large pool of people who will never raise a fund two. I've seen estimates that around 80 to 90% of Fund 1 VCs, that means they got into business, are not going to be successful enough to raise a Fund 2.
So what percentage only do one fund?
On the order of 80 to 90%.
Wow. So who are your investors?
So our investors include co-founder of Techstars, include a couple of leading VCs in Silicon Valley. To date, they're mostly finance and tech insiders, and VC insiders specifically, who understand our business and why it matters. We're still early in our development, so I can't yet tell you about the large university endowments, but give us some time to bring them in.
And does that allocation on those big funds, the big public pension funds, the university endowments, how much of their capital would they deploy toward venture capital versus private equity versus public securities? What kind of a percentage would they allocate to your world?
So there's been a clear trend in the past few decades, driven by Yale, I would argue, maybe I'm biased because I studied there, towards allocating more into illiquid alternatives, right? That was a key insight of David Swensen, who famously ran the Yale Endowment for many decades, that there is an illiquidity premium. If you're an institution with a infinite lifespan like a university, you should invest in the liquids and reap the illiquidity premium. If you're a 70-year-old individual, right, you don't have as much time to think about that, and so maybe you should.
Excuse me, I'm starting to feel ill.
There are exceptions, of course. So he, as a result, put a big chunk of the Yale endowment, like I think on the order of 50%, don't hold me to that, into illiquid alts. And
illiquid assets, right. Alternative assets, right. Which included VC, private equity, and something else.
Right. Timberland, I think they have 3% of the portfolio in Timberland. Real estate.
So he doesn't need the money short term, so he can afford to take a longer term view and give up the liquidity because he doesn't need it.
Exactly.
Therefore, he can hope to expect to get a higher return than if he felt like he needed to be in things that you could liquefy in it if you had a current need.
Exactly. So the big endowments will have some single-digit percentage, typically, of their capital into VC funds. And the big universities, particularly, they have relationships with some of the best VC funds and the Sequoias of the world, and so they'll deploy into them basically as much allocation as they can get, and they value that.
So David, leave us on a high note here. Why should we be hopeful that the world you know so well, the venture world, sees the opportunity in these climate and environmental opportunities, and that capitalism is going to help us find a way out of this problem?
Well, I'd say that there is clear economic opportunity in all of these mitigation solutions. And so there's a small percentage of industry that cares about impact, but there's a lot more that cares about returns. And so now that the crisis is so imminent, not imminent, I should say, it's here, the crisis is here, the economic return to selling solutions is very apparent. And so that gets more people excited who may not define themselves as a climate investor, they're a hardware or software investor, but they'll invest in something that pertains to the climate crisis because they can make the Benjamins.
We heard a surprising stat today about how much steel is recycled in this country from our friends at U.S. Steel, which I thought was pretty amazing and interesting. And then last year we heard from Bill Gross on stage here that they had just begun to be able to melt steel with a solar device. They had reached a critical temperature, I think it was around 1,500 degrees. So that not only is it a good material because it's infinitely recyclable, but if you could do it without a blast furnace and do it with a solar mechanism, I think there's some hope there. And like you say, David, if the opportunity is there and the returns are there, the capital will flow in. So I think so many of the people we heard from today talked about making these attractive capital opportunities, so we're not just walking around hat in hand asking people to help.
Yep.
David, thanks for your help today in understanding
Thank you.
this side of the world.